So welcome everybody. My name is Dr. K. I'm the co-founder of Quai Network. And today I'm going to be talking about our proposal for a two-token model to be used on Quai Network. Before we get started, I always want to cover just what is the goal of Quai Network. And so when I start out, there's sort of this trope that exists in the crypto space that says we need to onboard 1 billion users into DeFi. But by our numbers, there's only 700 million TradFi users. So how do you get 1 billion DeFi users when you're drawing from a pool of 700 million TradFi users? We don't really think that's possible. So for crypto to work, to get 1 billion users, it needs to first work as money before it works as anything else. So the goal of Quai Network is to be able to build a scalable system that allows a blockchain to function as money. With that being said, if that's our goal, we need to understand the scaling requirements. And if we look at different forms of payment, we can come up with an estimate that if we have about 50,000 TPS, we can function as money for most of the world. How are we going about doing this? So Quai Network has a multi-chain architecture. We have a hierarchy of merge mine blockchains that can dynamically increase throughput while maintaining security, some guarantees that are similar to something like Bitcoin. So on the left here, we can see a first generation blockchain, which is just running a sequence of blocks. And then on the right here, we can see a 2x2 ontology of Quai Network that's effectively running 4 state chains or zone chains asynchronously, and then coordinating that with region and prime. Right now in the testnet, we're running 9 zone chains, so it's a 3x3 ontology, so a little bit bigger than what you're seeing on the screen here. But today what we're talking about is, since we're aiming to be money, we need to talk about the desired properties of money. So what are the properties the tokenomic design needs to achieve for Quai Network to function as a monetary system? So when you talk about money, the properties of money have been discussed a lot within the crypto space, and people have probably seen these 7 things before. But money needs to be durable, portable, divisible, fungible, scarce, acceptable, and transferable. If we kind of try to assign values or ratings to how this has been done so far, there's some deficiencies, certainly with fungibility, scarcity, acceptability, and transferability. So in terms of fungibility, there are ways that you can get fungibility with things like Monero or Zcash, but in terms of something just like Bitcoin or Ethereum, there's a lot of lacking privacy, and with lack of privacy, you get distinguishment of each one of the units, at which point not all units are fungible with all other units. So we need some form of tool on the base layer to allow for fungibility. And in terms of scarcity, we also need a long-term economic model that allows for economic sustainability. So if we think about Bitcoin, there's a 21 million supply supposedly, but when we look at the throughput and the fees that can be generated by transactions relative to the decrease in fees that are generated through Coinbase rewards or inflation, as the Coinbase rewards are dropping, questions are being raised about the security margin that exists in Bitcoin and if it's long-term economically sustainable. With that, there is discussions that 21 million might not actually be 21 million, because given the economic model, that number may have to change to maintain security going forward. So if you don't have a long-term sustainable economic model, your ability to maintain a scarce economic distribution comes into question. The other issue that we have is acceptability, and one of the items that plays into acceptability is, do we have a stable token? So within the world of Ethereum, or Bitcoin, or just blockchain generally, I guess, we now have a plethora of stable tokens. So, USDC being one of them, Tether being another, and you can even look at something like Make or Die, an algorithmic stable. Now, for the stable tokens that are not algorithmic and aren't based off effectively a depth position, such as Tether and USDC, these stable tokens are what you might class as backed or custodial stable tokens. And one of the problems that these introduce is if there's $100 billion in USDC on Ethereum, and there's some controversial fork that has to take place in Ethereum, Circle has a very outsized say in which fork becomes canonicalized, and their say is independent of the protocol and the participants validating or mining the chain. So having a large amount of assets which are custodianed off-chain but referenced on-chain actually creates sort of a systemic threat to the independence of the rules of the chain themselves. Now, the one thing that stable tokens do get us is they allow things to be easily denominated in a unit, and lots of times this is still US dollars. But in terms of acceptability, if I'm a merchant, I can't really easily deal with something that has a high fluctuating value. I want to be able to price my goods and sell my goods. I want to have consistent pricing from my vendors. And if I'm in a highly volatile environment, not having sort of a stable basis makes my life a lot harder with greater degrees of friction and greater degrees of currency risk. So having a stable token in the system for commerce is really required to be able to function as money. And then the last thing really that systems suffer from right now is transferability. So can you scale with demand while still maintaining stable and low fees? So these are sort of the problems that we still need to answer. I mean, obviously we've done a ton of work on scaling, and with the scaling, you can generate a lot more of a fee base, which means you're starting to answer the scarcity issue of how do we get long-term economic sustainability. But to function as money, we still need to answer all of these problems, and that's part of what this presentation is. So the next thing we'll talk about is Gresham's law. And Gresham's law kind of sets up this conundrum about money. But this actually dates back, I think the first reference is to 400 BC. But the idea here is simple, and it is superior money is driven out of circulation by what we would call inferior money. So if we have multiple forms of money, people will have a preference for one over another. And this can be, a lot of times in history, this has been what we refer to as specie, or a Boolean-based unit, like a gold or silver coin, comparing it to a token or note that does not have the same intrinsic value as a gold or silver coin. So that could be, a cheaper, say, copper or nickel coin, or a banknote, right? So, if you see on the example on the right here, I have these Liberty dollars that prior to 1971 were 90% silver, and on the right we have the post 71 dollars, which have no silver content. And if you've ever noticed, none of the pre-1971s circulate because their intrinsic value of the silver content is much, much higher than the half dollar itself. So this is a phenomenon of Gresham's law, which is the superior form of money, the one that has an intrinsic value in its construction, silver in this case, will go out of circulation and be hoarded. And then the inferior form of money, in this example, the copper nickel composite, will circulate. So this has happened time and time again within society. There's actually a time in the mid-1800s in America where America was on a bimetallic standard. So we had both gold and silver coins that were circulating. And for about 40 years prior to the Civil War, that was the only form of money that circulated. It was only with the Civil War and the introduction of the greenback to that was effectively created to fund the war, did the gold and silver coins come out of circulation. But that's an interesting phenomena, meaning if you have a sound money system, let's, Bitcoin or gold or silver, let's say, and somebody creates a non-sound money system, the preference will always be for the population to not circulate this superior form of money or the sound money, and always circulate the inferior form of money. And this creates a conundrum, because if I want long-term economic sustainability, I need to have continuous incentives. I need to be able to get the miners to mine the blocks. I need to be able to create sort of an economic guarantee of immutability of the ledger in time, so I can finalize transactions. But to do that, I basically have two options. I can either do that by fee, or I can do that by inflation. So if I have inflation, that discourages the hoarding or the adoption of the currency itself. But if I have deflation, I encourage hoarding, which means no one's going to want to spend it, which means I don't get transaction fees, which means in the long term, I can't create a sustainable economic system. And we see this phenomenon with Bitcoin. So even if we were to forego the fact that Bitcoin can only do, say, 5 TPS, and we said it could do 50,000 TPS, people would still have a preference to spend dollars over Bitcoin if they have this expectation that Bitcoin has a deflationary model and it will be worth more tomorrow than it is today compared to the dollar. So the question becomes, how can we design a token system to reconcile which seemingly is a paradox in the design of money within society? And the simplest solution is that to meet the 6 additional requirements is that we need a two-token system. We need one token, which is deflationary, and we need one token, which is mildly inflationary and has a relatively stable value. And if I have both of these tokens, the net effect is that I can have an incentive to adopt the system, but I can also have a mechanism to ensure long-term sustainability, because we'll have a token that will encourage people to always spend transactionally and not just hoard. That spending will generate fees, and those fees can be used to pay for chain security. So users will always have the incentive to spend, and then fees will be adequate to reinforce the incentive design. A two-token system thus solves Gresham's paradox while also creating the desired properties of money. So what two tokens are we proposing, and what characteristics and functionality are we proposing for each token? So one token would be the Quai Token, and this will still have sort of the similar characteristics that we've talked about. It'll be a deflationary token. It'll have smart contracts. It'll be EVM compatible. So you can think of Quai as the superior form of money. So if we think about, Ethereum, or we think about Bitcoin, Quai has a similar model, so to speak, to those economics and sort of economics that we've been ideating. The two token change here is we kind of have this additional token now that we're calling Q. And it is an inflationary token, but it's going to have a stable value. And we'll discuss what that means. So we can think of Q as what we're calling an intrinsic value token. And it's going to be in fixed denominations on a UTXO ledger. So if you have UTXOs at fixed denominations, you've created a system which has fungibility similar to cash. So we've met the fungibility issue. We have something that's stable. We can denominate goods and services and transact using Q as a denominating value. We also have it being the non-preferred token because it's not deflationary, certainly not deflationary relative to Quai. Q would be your broadly circulating token for transactions. So to understand how these two things work, I just have to go back and cover POEM for a quick second, or proof of entropy minima. The inspiration for these tokens kind of stemmed out of Poem, I'd actually been thinking about how to design a sustainable monetary system for quite some time, and have been doing a lot of reading, of all economists, trying to sort of understand a model that may work. The interesting thing is you'll run into Gresham's paradox, and modern economists, honestly, are really just propagandists for the state, justifying the creation of the central bank and the debasement of money. So you can't draw a ton from any work or academia, because economics is a political system. It's definitely not a science, and it has nothing to do with proper monetary design. That being said, with Poem, it kind of gave me inspiration on what would make sense to have in terms of a system where one token is hoarded and one token is spent. Poem kind of gives it to you in some ways. Just within the system, the reason we're using Poem is that it allows for single communication around consensus. And this is really the mechanism that allows us to shard multiple blockchains and scale blockchains to our TPS numbers that we're going for. But there's interesting mathematics involved in Poem. So entropy, which is the basis of Poem, is measured in bits. And bits of entropy are basically saying how many sort of paths I've sort of removed from the system with the creation of a certain block difficulty. And then within the aggregate chain, I can get total bits removed from the system since Genesis, just by doing sort of a carry on total entropy reduction. So entropy is measured in bits. Bits is related to, you can see, or delta S is 1 over 2 to the n. And there is sort of the bits of entropy reduction. And the other thing is bits is effectively, it's the binary log of hash, not the square, sorry. But bits is related to the binary log of the hash. So we have two sort of features in the system. We have hash and we have bits. Hash is sort of a linear property with input into the system. Bits is a logarithmic property with what is input into the system. And the cost of hash is linked predominantly to the global average energy price. So if I asked what the price of producing a hash is, if I know the electricity and I know sort of the efficiency of a GPU, I can tell you what the cost of that hash is, and its variability in cost of production would really be the variability in the electricity. So what we want to do here is we want to utilize this fact that hash is linked to the value of electricity to create a intrinsic value token, or token whose value is correlated to the global average energy price. In addition to that, then we can maintain our deflationary token with Quai using bits. And bits, as far as we're concerned, is linked to the square of the number of users, which is roughly a mechanism for understanding the total value of the network as a whole. So hash, in summary, is a proxy for mining cost, and bits is a proxy for network value. And this just comes straight out of sort of understanding Poem. So then what is the sort of distribution mechanism for Q and Quai? And then how does that dictate the dynamics? So the idea here is that the only way to sort of distribute this token or tokens fairly is really mining, and Poem, again, is this critical mechanism for scale that can only be done via mining. So distribution will be done by mining. Now, when we're mining, though, we're going to give miners a choice. And with this choice, we're going to set up dynamics that make the properties of Quai and Q interesting. And those dynamics are simple, or sorry, the choice is relatively simple. When a miner is mining a block, they're going to be able to elect to receive Quai or Q. And Quai will be paid proportional to the bits in that block, and Q will be paid proportional to the hash. So if the miner sees, oh, and there's one other option we're giving the miner, which is at any point in time, they can convert Q to Quai at the current difficulty. So there's effectively an exchange rate in the chain, which is the difficulty of the block, which relates sort of the relationship between Q and Quai. And if a miner has mined Q in the past and they go into the future, they can then elect to use this mechanism to convert Q one way into Quai. Now, Quai won't be able to be converted back into Q, but Q can go to Quai. So what does this mean in terms of what will happen to the dynamics of Q and the dynamics of Quai? So a miner will prefer Q if the market price is greater than the production price, or they think the future expected value of Quai, and by proxy here, the hash rate, may be lower in the short to mid term. So what this does is this basically creates a mechanism whereby Q will achieve a price in the market which is related to the price of production of a hash, given these sort of options to the miners. So with those options, you kind of get this concept that Q is now going to be the production price of a hash, and Quai is going to reflect sort of the growth and size of the network. So the other thing that we're introducing here is market determined issuance. So how is the supply of Quai and Q determined? It is determined algorithmically by POEM, effectively. So effectively what happens here is the market gets to determine the distribution by the hash rate. So the more hash rate there is, the harder it's going to be to find Quai, and sort of the slower it's going to be emitted. The lower the hash rate is, the easier it is to find Quai, and more Quai will be emitted until the hash rate goes up. So if we think about this as an adoption curve, the interesting piece here is we've unconstrained this system in some ways so that the market can be responsive to the issuance and the issuance can be responsive to the market. What we can do here is we can make sure that Quai is always relatively deflationary though. So what that means is if the system creates Quai and it doubles the supply of Quai and the number of market participants is also doubled, you have a relative neutral monetary policy on Quai. So you wouldn't necessarily anticipate the price of Quai changing. But let's say, as with POEM, if the user base doubles, we're actually making it twice as hard to find Quai. Quai will always be net deflationary relative to growth, meaning, you know, if we double in size, I'm having the amount of Quai going into the world, so that would create a deflationary price profile. The interesting thing here is we don't have to prescribe a time to market growth or market adoption. Just letting POEM adjust the issuance is sufficient to let the system adapt to whatever rate of adoption that the market determines to be effective. So what that means is both Quai and Q will ultimately have a fixed supply, or it will logarithmically approach a finite number, but the market is going to dictate what that finite number is based off the rate of adoption. So if the rate of adoption is very fast, the total supply will be lower. If it's slow, the total supply will be higher, and that's basically it. So the benefits here is that this creates market responsive issuance, and it makes it so that we don't have to constrain the system based off some predetermined a priori timing. The market will always adjust, and the system will adjust to the market. And what this means, though, is that bits-based issuance allows for the market to optimize distribution and supply. Yeah, and that's like the first intro to this idea. Obviously, we're going to expand on this quite a bit more. Yeah, but with that, I'll take questions.
Perfect. I see a couple in the chat here already. I think that was a good intro, and I'm sure people will have a bunch of questions about this. So I'll start off with some questions from 80 kilogram Kotikov that we have here. He asked first, will we get the rewards for testnet in the Quai token or in Q?
Yeah, so all rewards we've said will be in Quai, and everyone will still get them in Quai. The issue with Q is it can't really be pre-mined because of the dynamics that it needs to set up to be a reflection of the hash value. So yeah, everyone we said will get rewards in Quai, and if people want Q, they're going to have to mine it at market at the rate, and that's just the necessity of the dynamics of making Q an intrinsic value token.
The next question we've got is, do I understand correctly that Q will be a token that rewards miners because it is inflationary?
So miners will always have the option of taking Quai or Q, and they'll do it based off of maximizing either their instantaneous profitability or sort of using Q as a hedge mechanism against price movements in Quai. The benefit to Quai, though, is that Q creates a dampener to both extreme positive and negative volatility. It kind of acts as an inverse bonding mechanism, if that makes any sense to anybody. It's not a bond, it's like the inverse of a bond, so to speak. I don't know really how to describe that in any better way. But there's certainly symbiotic dynamics in terms of creating growth and price stability.
All right, next one. Can you please explain what the Quai token and the Q token are for in terms of usability and like utility? So I know you mentioned that the Quai token is the smart contract token, but you go maybe into more depth on what you hope people to use these tokens for?
Yeah, I mean, the idea here is we have Quai, which, we've said is, going to be EVM compatible, DeFi type system, right? Smart contracts, composable, account-based. That's all true. That's all still true. So anything that you would use Ethereum for, anything that you would do in finance, you would really have to do in Quai. Now, if you want to, quote unquote, go risk off, you could hold Q, and you'd get a mild inflationary rate for doing that, and you certainly wouldn't get the deflationary benefits of holding Quai, but you also wouldn't be exposed to the same price volatility. So in terms of what I would anticipate people using these things for, Q, I would think of it as a transactional system, much as cash. So if you just think of Q, right, fixed denomination UTXOs, there's no smart contracting, there's no nothing. I can hold it, I can spend it, I can settle it, and that's about it. So you have this like very, very simple cash-like system, and then you have this more complicated, risky, but also potentially beneficial finance system. And then people can kind of dictate what they need to do based off use case as well as risk appetite.
Perfect. And I've got one more question from 80 kilogram Kotikov, and then we'll keep going to everyone else's questions. But he asks, by adding a second token, you in some way added a choice for miners in terms of what is more profitable to mine. But if you say that Q can be converted to Quai and vice versa, won't it work that people will won't mining Q and mining Quai be equally profitable based on people like splitting up into different zones?
So there's no vice versa here. First off, Q can only go to Quai. Quai cannot go to Q. Now, obviously, the market would likely create an inverse trade, but that would be based off aggregate liquidity, and whatever that market is, that wouldn't be something the protocol guarantees. If you want to think about really what's happening here, is we're offering a new utility value, which is Q, and Q effectively eats away at the issuance of Quai. So all Quai holders benefit from Q's existence because it will lower the net aggregate supply of Quai sort of at any given point in time. And then it will get converted back at some future date, but it can never really get converted back in a growth scenario at any less than it was converted to. So whatever goes into Q will then end up lowering the aggregate terminal supply of Quai. So from a Quai's perspective, Q is only a beneficial thing. The other thing that it does is that it creates that stability mechanism. So if people are expecting the value of Quai to drop or the hash rate to drop, miners and market participants would start trying to buy up more Q in anticipation of that drop. This gives a native sort of risk-off asset class in the system, but it also then would create a counter-cyclical stability mechanism. So the reason that, say, a miner would start electing to take Q, even if the price is not over market, is they're expecting the hash rate of Quai to drop. So then what they would do is they would just mine Q with the expectation that when the hash rate drops, they can exchange it back for more Quai in the future. But that's going to create the stock to flow of Quai dropping. So it's going to create sort of a stabilization mechanism between the two pairs.
Got it. And I have another community question here. Does Quai or Q have a fixed supply, or do neither have a cap? And I'll add on my little part, which is if Quai does have a cap, how is it fixed supply if miners can convert Q into Quai?
Right. So there's no cap, but there is a cap that will exist based off terminal adoption. And if terminal adoption is the entirety of the planet, like there's a physically limited cap that will take place. So once that adoption stops, there's a logarithmic approach to a fixed value for Quai.
Can you clarify that a bit more? So at a certain hash rate or difficulty, there is a fixed supply, but as that difficulty grows, the supply can also grow?
Well, because every time the hash rate doubles, it gets twice as hard to find Quai. So the issuance goes down as the hash rate goes up, right? And there's a physical limit to what you can do in terms of hash rate production on the planet, given polynomial time of a hash function, of finding a hash function, right?
But it's not. So it's more similar to Ethereum, where there's like an emission schedule, rather than like a Bitcoin where there's like 21 million, and there will never be more than that.
Yeah. So it's similar to Ethereum, except that there's the emission schedule is the market's determination of the value and the future expected value of the system. We are not creating constraints. The market will dictate the thing.
Got it. I've got another question here. Can something like Tornado Cash improve fungibility for Quai?
Yeah, it can. The issue that you have with Tornado Cash and Zcash, if we're talking about these things, is that your anonymity set is small, and temporal analysis on a small set is relatively easy to conduct. So something like Tornado Cash, which is only a small percentage of Ethereum transactions, even though they're not sort of directly linkable, they kind of are. And the same is true for Zcash because not all of the transactions are shielded. So in the proposal for Q, what we're talking about is fixed denominations with a UTXO set with protocol enforced non-address reuse. So that is perfectly seeable on the blockchain, but deconvolving the links would be challenging.
Understood. Let me see. So we got a question, what is behind Q? For example, USDT is backed by the dollar.
So Q is backed by a hash.
All right.
So if you want to think about it this way, let me give an example.
Yeah, for sure.
Right, gold functioned as money in history. It's pretty, but fundamentally the property that we've always been going for when we say sound money or even commodity money is that everybody can independently verify what it is, and there's a roughly equal expenditure of work by all parties to produce that good, right? So what gold really is me showing you a coin. You can verify that that's a gold coin, and you can say, he put X amount of work into producing this gold coin because we sort of have this physical constraint of being able to find, mine, and refine gold. So it's kind of been our physical mechanism for proof of work prior to sort of this digital format of proof of work. So when you think about what's backing gold, energy is backing gold. What you think about then with Q is that it's backed by a hash, but what's backing hash is energy. So what we've done here is Q is energy-backed money.
And so building on that, someone asked a question, they're looking for a deeper understanding about how the mining and the electricity parts interlink and how that adds value to a token. They're asking if you could explain that concept in a simple manner.
Yeah, so if we look at a miner has input costs. They have a CapEx cost and they have an OpEx cost. The majority of their cost is OpEx, and the majority of the OpEx cost is electricity. So if I'm to say what is the value of, or what is the cost of producing a hash, it's going to be proportional to the cost of electricity. The other two kind of go out in the wash. It's really just electricity costs. So if we set this option game up where people can elect to get QR Quai, the DeSIC strategy for a miner is only going to be to produce Quai when it's marginally more expensive than the market clearing rate. So that means there's greater demand for Q than there is supply. The miner will produce Q and sell it at market until the value of the market price comes down to the price of production. That dynamic sets up Q being the value of a hash, which is really the value of electricity.
I've got a bunch of really good questions here. I'm going to start with probably the easiest one. How significantly is the new tokenomics paper going to differ from the previous tokenomics we have released?
So I mean, this isn't really talking about tokenomics, right? This is talking about the two-token system. We'll be coming back with, tokenomics. Right, within this system, we kind of have to make guesses on what we think terminal adoption is and adoption rate is, and that will back out kind of the initial supply, kind of based off those estimates. And our goal is to sort of keep things consistent based off the estimates.
Got it. And I've got a question about the reward structure. I assume it's for the Iron Age testnet, but the question is, like assuming that one miner mines 10 easy blocks while a different miner mines 5 difficult blocks, will both miners be rewarded differently, or is it only by the number of blocks mined, or does the complexity matter when it comes to rewards for this testnet?
Yeah, so for this testnet, the reward structure is per block. So the goal for miners should be to find the easiest zones that has the lowest difficulty, that reward the least amount of quai per block. That is the amount of quai you're getting rewarded per block is telling you the price that you're paying. So you want to minimize that number to maximize the number of blocks and thus maximize your rewards in the Iron Age.
And then can we, apply that to mainnet? On mainnet, will that be a similar structure where miners are just rewarded based on, how many blocks they've mined, or will it be based on the difficulty of those blocks?
Right. So in the Iron Age testnet, one of the activities that we're going to get into is doing TPS. And we set the dynamics of the tokenomics to effectively be Q, because we want a cost to running sort of continuous rates of TPS, which kind of lets us moderate, how much is going on in the network at any given time. That's just from an engineering perspective, we're doing this, right? But the dynamics with Q is that Q is rewarded linearly with the increased difficulty in block, but Quai is rewarded non-linearly. So if you mine a block that's at, say, 30 billion difficulty, with Quai, we'll say that's 20 bits, okay? So you'd get 20 Quai from that. If you mine a block that has a 60 billion difficulty, that would equate to 21 bits. So you can do twice the amount of work and get a 5% return, increased amount of Quai. So your Quai does go up, but it goes up logarithmically, not linearly. So with that logarithmic reward function, everyone's always going to be highly incentivized to find the zones that have the lowest difficulties.
Got it. And more of a less technical question, but how ready are you for the mainnet launch? What are the main challenges that you kind of currently see arising, and will you launch in a bear market?
Bear market's the best time to launch, right? Because it sets you up well for a bull. I think our launch target, right, is both technically dependent and market dependent. We're certainly trying to get this done as quickly as we can. The thing that we've proven so far in the Iron Age testnet is that the core concept of a threaded hierarchy of merge bind blockchains using POEM as a consensus mechanism works. Like, that's what we've shown so far. We've actually, over the last 5 days, had what would have been considered to be attacks on the network. They weren't malicious, I don't think, in any way, but they were departing from what would be dominant strategy incentive compatible behavior, and it's let us learn something about some of the less important but still very relevant mechanisms that we have within the system, like how you choose your sync choice, how far you listen to blocks which are not on your canonical tip or classify stales. So we're definitely learning something in this testnet, and it's not like trivial stuff. It's high level conceptual stuff, and the testnet has been great to show us conditions that we did not anticipate, and that's really the point of running a testnet. So from that perspective, though, consensus has survived effectively 2 very highly valued sort of malicious attacks in the last 5 days. So we're very happy with how the consensus engine has been performing thus far. Those quote unquote attacks, right, did make syncing less efficient because people were having to append effectively multiple tips into their system for longer than necessary. 19.4 gave us a better reclassification of how we do stales. So we were doing stales by number. And basically, if something was classified as not being stale in one context, it would allow you to append it. So you could get a block that was the same zone number, but 200 blocks back in prime, and Zone would classify that as a non-stale, and then start trying to download and append that alternate chain tip. So what we've done since then is now stales are classed by entropy. There's an additional instantaneous entropy classification that's going to be coming in with 19.5, but this should make the system much more resilient and reduce the load on nodes when there is non-DeCic compatible divergent behavior in the network.
Got it. And I'm going to jump over to Kishore's question real quick. So Kishore asks, so we peg the number of participants to one outside variable, energy, and let hash power and N be the balancing factor in the inverse ratio between the two. My question is, the more energy efficient society gets, the more energy efficient our economic system would be. In other words, the more energy democracy we achieve as a society, the more democratic our money can get through this two-token policy.
I would agree with that statement.
All right, and then the last question I see here is asking for a re-explanation about the Gresham's law concept, specifically applying it to gold and the US dollar.
Right, so basically people saw the US dollar as an inflationary asset and saw a risk to the redemption of dollars. So gold coins stopped circulating because people knew that they could get gold coins, and if they ever got dollars, they always wanted to get rid of those first before they started spending their gold, because they valued the gold more highly. And that process took a while, but eventually, right, if we kind of go back in history, the dollars used to be gold notes. If people are familiar, and that happened all the way up until the Great Depression, and there was executive order, I believe it was 6104, which criminalized the ownership of bullion and tokens by Americans. And the federal government went into everybody's safety deposit boxes and took any gold coins or bullion that they found, and people were compensated at $20 per ounce. That was the sort of credit event wherein, people realized that gold was the superior form of money, and dollars were the inferior form of money, and that event just proved their suspicion to be true, so to speak. And then the interesting part there, right, is after I believe it was 1933, it was illegal for U.S. Citizens to hold gold up until 1971 or 1972. So what ended up happening is, the Bretton Woods Agreement was kind of in the middle, but everyone was paid $20 for their gold. By the time it traded openly back in the early 70s, it was $800 per ounce. So effectively, over that 37-year period, people had what is that, like 96% of their value taken from them.
And I guess the final question I have here is a little more related to governance and on-chain governance. What are your thoughts on on-chain governance, and is Quai Network taking any approaches to tackle that?
Decentralized protocols don't have governance. So the concept here is that we are going to release a product at Mainnet, and it's a protocol, and the protocol is the protocol, and you can change the clients, but the protocol shouldn't change, so there's no need for governance. That being said, if there's an issue, I think that there are community-based mechanisms that will allow resolution of issues in some time frame after launch. And that's perfectly appropriate, but then will end up happening in a well-designed system is the number of interests will become diverse enough, and economically speaking, such that it is impossible to change the system after that. So the protocol ossifies. And if you look at Bitcoin, Bitcoin kind of went through an ossification that we saw with the battle that kind of took place with SegWit. Bitcoin was ossifying. Now the fact that sort of the Bitcoin community has shrunk in some ways, certainly in relative economic diversity terms, maybe that ossification is unossifying. But the goal here is to design an economic system that works. It functions as a protocol. Anybody can use it. It doesn't need to change. People can develop clients, but they'll develop clients to that protocol. There can be more or less efficient clients. It can evolve to changes in technology, but the protocol is the protocol, right? An example I like to pull here is TCP/IP. TCP/IP was codified in the early 80s. It hasn't changed, right? It hasn't changed in whatever that time period is, 30 years, let's say. The only change that has taken place is the optional upgrade from IPv4 to IPv6. And that's done strictly on a backwards compatible basis and on an optional basis. So you can say, I can have a protocol, it can be a technical protocol, and it doesn't need to change over many decades or years. I don't think that there's any requirement to figure out how to update this system in a properly designed base protocol. It will have the hooks that you need to add on the things that you want and build in advance, right? When we did TCP/IP, you didn't anticipate Gmail, but like Gmail can be built on that, right? You didn't anticipate any of the things that we have. We didn't anticipate Facebook, but like we don't need to go change TCP/IP to have Facebook. And the same thing is true here. We have a lot of participants. I do know that we had something like 1,700 unique ENR records in the network. So that should roughly equate to the number of nodes that are running or trying to run. And then, we have quite a bit of hash rate, and we appreciate everybody who's participating. We know that, with this testnet, we are actually testing and we're actually learning things, and we appreciate everybody's help in doing that.
Awesome. Thanks for the presentation, Carl. Thank you everyone for joining and hanging out with us today. Hope you learned something. And if you have any questions about, the testnet, tokenomics, anything that Dr. K discussed today, drop them in general or testnet discuss or any of the channels in here. And Dr. K and the rest of the team, I'm sure would love to chat about this kind of stuff. So thanks everyone. Thank you, Dr. K, and we'll catch you next time.
Thanks, guys.